Okay, good news. First American, the title company, they put out a report. They do some research themselves, which I was impressed by. They are forecasting multifamily cap rates. They're poised to slip in 2026. Remember, cap rates going down means prices are going up. So if you're an owner of multifamily properties, cap rates slipping is a good thing. If you're trying to buy, things are getting more expensive. Might be tricky. That's why we said you really want to be buying now. Don't wait. Let's go right to this chart. Coming unstuck in time. I'm just going to read this. Bear with me. First American's multifamily potential cap rate model estimates that the market supported potential based upon key fundamentals, including multifamily transaction volume, a measure of purchase demand, renter household formation, a measure of leasing demand, and multifamily debt flows, a measure of credit availability. When the multifamily PCR is below the actual multifamily cap rate, as is currently the case, it suggests that market fundamentals support lower cap rates than what we're observing. And then it says the chart below compares the actual multifamily cap rate over time to the multifamily PCR, which is their model. Both actual and potential cap rates rose in 2022 through 23 as the market adjusted to higher interest rates and repriced risk. It then leveled off. We've talked about doing this same kind of analysis, Griffin. We've steered away from it because some of the cap rate data can just be so god awful, and opaque and all over the place. I mean, I could point to cap rate studies today, and we were going over this when we were looking at the research report because we were thinking about maybe including some of that. I mean, ranges from 5 to 7%, or even 4.5 to 7%, depending on who you ask, which study you look at. They're using some tighter numbers that look a lot more familiar to me and more real when I'm actually talking to owners and brokers. But I don't know, this looks like good news for next year, potentially.
Good news for next year. I think the most intriguing thing when I look at this chart, really it's a 23-year span, it's the largest spread between actual cap rates and their multifamily potential cap rate. And so you would like to think that those two are going to, become married up, in the near future. It can't stay at that spread for too long of a duration. So either, like they're predicting, actual cap rates do need to compress or slip, and or their multifamily PCR is missing data or is interpreting the data maybe a little bit differently than it has in the past. So their prediction for it to come down and couple back up with its PCR makes a lot of sense.
I think part of it might just be the again, that uncertainty in the market and the lack of transaction volume and the fundamentals that should drive pricing are pointing towards cap rates maybe should be a little bit lower, but that risk and uncertainty is causing buyers to demand higher returns, and they only will buy it if they are paying a lower price and a higher cap rate. I mean, I feel that if I want to buy something right now, even though I could be bullish, I'm like, well, given the uncertainty, given the market conditions, given that we're not forecasting strong rent growth next year, you need to pay me I need to pay a lower price because I can't bet on a ton of growth. I can't bank on cap rate compression, even though maybe there's a projection, but what are projections really worth? They're not worth a whole lot. I have to trade on the fundamentals and the realities of today, which is, hey, slower growth. That means I need some cash flow. It means I need to pay a higher cap rate. That's the mentality. But the fundamentals are telling a different story.
Right. This is exciting on the sell side, but on the buy side, it seems like really the last, let's just say 2 years, I've been hearing you, Jay, and everybody in the office talk about, that the bid-ask gap, or essentially what the seller is expecting for their asset. And then, similar to cap rate expansion, we've been asking for price discovery. On the buy side, obviously, we want to pay a better basis for the asset. And so moving forward, as we're predicting this article is predicting cap rate compression, cap rate slipping. How does this change our operational standpoint moving forward in regards to the acquisitions that you were talking about? Maybe not buying based on predictions, but buying on firm-rooted data and historical T12 rent rolls.
Yeah. I mean, it's core to our acquisition strategy right now, to be honest, because we have to use this kind of fog of war, this uncertainty, to make strategic acquisitions. And the only way we're allowed to do that is two things. One, we have a long-term hold, mindset and
Patient
strategy.
capital.
Patience. And we're also very bullish and convinced of the underlying fundamentals for housing over the next 10 years. A short-term strategy we would not be able to kind of go in and execute. It's only by taking a long-term view of having a high degree of confidence that we're going to see rent growth over a 10-year period that's over expense inflation. And we're also going to see probably some cap rate compression at some point. And you want to put the least amount of weight on that cap rate compression. But it is a driver of, we think this is a good opportunity to pursue right now. And so it's letting the noise and the uncertainty and the low rent growth that we're projecting and others are projecting to get people to second guess themselves, to be hesitant. It sounds almost two-faced. We want our LPs to be confident, obviously, in us and in the market, but we want the rest of the market to be scared and uncertain and stay on the sidelines. Because in 2022, in other periods when there was just peak demand to buy and acquire, that's when it's so hard to find good deals. And even though you can underwrite high returns, it's the highest risk period because you almost have to overpay because you're relying to some degree on some sort of cap rate compression. And then we're just going to pop it off. We're not going to have to do anything. It's just a high growth environment. The market will take care of itself and it becomes a feeding frenzy. You can make a lot of mistakes. Versus there's not many buyers out there in the market that allows us to be much more competitive, get better terms on acquisitions. And the challenge is not getting too greedy and requiring such a discount. Because everyone wants to buy pennies on the dollar.
Right.
I'd rather buy 70 cents on the dollar, something at 70 cents on the dollar, a couple things at 70 cents on the dollar, maybe 60 cents, maybe even 80 cents, than wait to buy something for 40 cents on the dollar and not buy anything.
Yeah, potentially lose a deal by just trying to be greedy.
And it's not greedy in the bad way. You're looking for a great deal. You're looking to buy it at a discount, but you have to be realistic. There's a lot of capital chasing these multifamily deals. It's hard to decide where to put your money right now. You're not the only, even though a lot of people may be out on the sideline, doesn't mean everyone's out on the sideline. There are still players that are playing the game. And so you have to know where the balance is of, all right, we're getting a good deal. We're getting it less than it would cost to build it.
Yeah.
But we're still competitive enough of where we can actually win the deal because there are still a couple buyers. So we want to move as many people over the sidelines as possible, but then still find where that sweet spot is to acquire at a price that we can actually win the deal when it's possible.